Welcome to the Agent of Wealth podcast with Marc Bautis from Bautis Financial. In this podcast, Marc helps guide you towards financial freedom, ensure you never run out of money, and create a balance in life that prioritizes what is most important to you. Join us for this journey as Marc draws from years of expertise and guest experts to solve the multiple wealth building challenges involved in your financial life.
Welcome back to the Agent of Wealth. This is your host, Marc Bautis. Today I'm joined by a special guest, Scott Stanfield. With a PhD in engineering and extensive experience as a research scientist, Scott transitioned to real estate, amassing a portfolio valued at over $3 million. As the author of Passive Profits, the Turnkey Rental Investor's Guide, he provides strategic insights into turnkey property investment, aiming to empower individuals towards financial freedom. Scott, welcome to the show.
Thank you for having me.
So maybe you can start off with what exactly is turnkey real estate investing, and then how'd you first get into it?
I guess I'll start with how I got into it and then talk about more what it is. So I finished college, my undergraduate in 2005, and it started professionally at that time as a co-op. This was at the Air Force Research Laboratory in Dayton, Ohio. And I just continued down that path. I completed a PhD, and then I stayed there and I worked for many years. And when I was working, I knew I wanted the flexibility to work if I wanted to, or have something else. And that's ultimately what led me to my path on real estate investing. I started off in real estate, I guess more traditionally, like most people. I found properties and then I managed them and what have you. And that took a lot of time. And so I was very busy, working full time, and I just didn't have a lot of time for that. So I started looking for something different, something that was just better for my schedule. And that's what led me to turnkey rental investing. And so really all turnkey it's a long-term investment strategy where you source your properties from a turnkey provider. And so these are companies that they find houses that need to be renovated. They do the renovations, they place a tenant, and then they sell it to an investor. And so for me, it was basically outsourcing the entire rental business in just one purchase. So most of my time was spent on the purchase side. So I wanted to make sure the renovations weren't too cheap and that they were actually quality properties in the right location. Really a lot of time screening the turnkey provider and their management teams, that sort of thing. And then once I own the property, I don't spend a lot of time managing it. I look at the numbers once every month, and that's really was key for me. Again, I just didn't have the time for it, but I did have the extra money, and I wanted, obviously, the benefits of real estate investing. And so that's how I got started, and it's worked very well for me. My portfolio is now all across the country. I'm in many different states. It's performed very well, and it's really been a life changer. And so that's brings you up to how I got investing. So I guess I'll go ahead and just throw out one last piece. Why did I write a book about it? I had family and friends asking me how I was doing this. They were very interested because I was excited. I was getting great results, and so I was talking about it. And anyways, they were very interested. So I had a lot of notes. Probably won't surprise anybody, but I spent a lot of time researching the topic and really putting together systems. And so I took my notes, which included checklists and things like that to complete just every process of the business. And I began to create a book out of that so that I could share it with other people. And that's how this started. The whole point of it is just to help people that would also like to get into investing that maybe not have a lot of time. Maybe you're some sort of working professional, or maybe you're doing other stuff as an active investor and you're making a lot of money, but you want to build your passive side without taking time away from your bread and butter. So your main strategy. And so that's where I started, how it developed, and why I wrote the book.
So let's start off with this journey from the, goggles of a first-time turnkey investor. Start off with, how do they figure out, you said you have properties all over the country. How do they figure out that first one they're buying, where in the U.S. to buy it?
This shouldn't surprise anybody, right? So if you're interested in housing and creating a business with housing, you're really just providing a product for housing, right? So you want your houses to be in a place where there's growth. So the first metric that you're going to look at is population and population growth. I like metropolitan areas that have a large population base because I want the statistics that I look at to actually have meaning. And then two, I want to see that that population is growing and has been growing for a long time. And so I have some filters that I use for that. Actually, I built them into a spreadsheet so I could share it with other people. But anyways, it's free. It's on my website. But the point is, you can filter through all the statistical data on a metropolitan area and identify the metropolitan areas that are going to be a good investment for you. And again, it's really not that complicated. I maybe make it a little harder than it needs to be, but the reality is, if it's a large metropolitan area and people want to move there, and the population's growing, it's going to be a good place to invest. Now, if you start to look at the financial numbers and you're like, well, it's not cash flowing or something, maybe it's a high price point area, just remove that from your list. Focus on areas that produce cash flow that have a growing population base. And that's really the key.
Should an investor look for both cash flow and appreciation, or with turnkey properties, is there one that maybe they should focus on more than the other?
Cash flow. Cash flow is really important. You don't know what's going to happen in the market. Nobody does. Even all these gurus that tell you they have it all figured out, they do not. The market is unpredictable, and cash flow is what pays your bills. Cash flow is what takes care of unexpected maintenance or anything like that. And so first and foremost, you have to have cash flow. If you're buying in an area that has population growth and it's a desirable area, there's going to be appreciation. It's really a matter of supply and demand. Now, you may see a retracement momentarily. Maybe there's been a lot of building, and I'm just talking in general. But if you were to back out the time scaling, you start looking at multiple years down the road, if people continue to move there, they'll eventually absorb all that surplus supply, and you'll have appreciation. And if you were to look, for example, at historical appreciation rates, so this is the U.S. average for a single-family home, it's about 3.8% annual. And of course, if you're in areas that have demand, right, it's actually going to be a little higher than that on average. And of course, you don't get that number every year, right? This is just an average value. But the point is, if you buy in an area where there's population growth and you plan to hold it long term, you will start to experience appreciation rates that are going to converge somewhere around that average, maybe a little higher, maybe a little lower. And so if you buy for cash flow, everything else takes care of itself.
When you're evaluating cash flow on these properties, is there like a baseline or a call it a floor of a class or a type of property that you won't go below? Because there are certain properties where the cash flow looks great, but maybe it's in a lower class and of type of property, and you're going to wind up a lot of the cash flow is going to be eaten up by turnover or repairs or things like that.
Yep, no, very, very true. And so, yeah, I don't buy properties that are in rough areas. I prefer areas where property price points are going to start to conform more to the average for the metro area or slightly above average. I say it that way because different metropolitan areas have different price points, right? San Francisco is very different than, say, the Midwest. But in general, if you're finding like B, C level neighborhoods, and I don't really like giving them a grade like that because tell me what is a B neighborhood. But for the sake of just facilitating conversation, it's like a C or B grade neighborhood that I tend to focus on. So this might be like a typical suburb area. So it's not like the most expensive place, but clearly not the cheapest. Reasonable schools, mostly because I target single family homes. I'm really looking at families, right? So I want to see 3-bedroom, 2-bathroom minimum. 4-2s are really good. I like having a garage. I like being near schools and amenities. If I buy like that, I expect the cash flow to be somewhere, and so I should mention too that the price point I usually target is between about 150 and 250. And I do have some that are more expensive than that. But in general, that's been the area that I target. And that really just kind of converges on where your typical or average person in a metro, for the metros that I target, are able to afford. And so these tend to hit a lot of the neighborhoods that I'm describing. And then the cash flow numbers tend to be about $300 per month or higher, roughly. And I try to keep it about that because that gives me enough money to cover any sort of variable expenses, right? Maintenance, et cetera. And then there should be extra funds for, to just put aside for a rainy day or for investing in other strategies, right? So obviously cash flow at that rate isn't going to build up quickly and buy another house, but it does cover your expenses and it can be put to use in other investment strategies. And so I do, reinvest those elsewhere. And then as the funds build up, especially the equity, then I'll look to refinance or maybe selling options and try to either scale into multiple houses, et cetera. And so that's roughly how I go about doing it. Obviously, this is just a description. I do provide checklists that walk you through the entire process. So every single actionable item, everything that I actually evaluate when I'm doing this, I have in there. And that's meant to be a starting place for people, right? It's not, maybe you go through that process and you go, oh, wow, but he could have put something here on this. I really want this. Take that as a starting point and then make it your own.
When you're purchasing them, or when you see people purchasing, are they buying these properties in cash, or are they able to obtain loans?
I buy with mortgages. I like having that leverage position. That's one of the key advantages to real estate, in my opinion. And obviously, you can't always buy with a mortgage. Right now, things are pretty tight with high interest rates, but that's not typical. Normally, there are opportunities to buy with a mortgage, and even now, there are ways to buy the interest rate down and things like that. And I am seeing some properties that do produce the cash flow numbers that I'm talking about. But anyways, yeah, you can buy with a mortgage. I do. I like having it, again, for leverage and also as a hedge against inflation. For people who are wondering what I mean by that, there is really no better hedge for inflation than an income-producing asset with the expectation to appreciate that you've bought with a mortgage, right? So you're borrowing this money and you're going to pay it back over time. It's really a short position on the dollar.
You mentioned that the portfolio is either all or mainly in single-family homes. A lot of times you'll hear investors who say, oh, single-family homes are great to start out with, but then they transition to multifamily, and then eventually their goal is to get to like larger scale apartments just for like scalability. Is your plan are you planning to keep in single family, and what's the trick to getting it to scale if that is the plan?
Yeah, you can definitely learn a lot with just single family rentals, and you can use that as a way to springboard into other investment types. And you really should anyways, or at least consider it, right, for diversification purposes, just being in different asset classes. But as far as scalability goes, one of the benefits with a turnkey provider or multiple turnkey providers, once you find providers that are very good, they tend to have houses every week, one or two or so that come online. And so for most people's resources, you can just continue scaling that way if you want, right? You can buy many, many properties that way. Now, should you do that? I think there's a lot of advantages to scaling with single family homes, but I wouldn't limit myself to that. There are also very good reasons to buy property in just other asset classes, multifamily or anything else. So I think it really just depends on what the market is willing to give you, right? So you look at the market, you see how it's shaping up, you try to project where you think it's heading and how best to position your portfolio to take advantage of the market, right? You don't want to force something. So instead, you look at what the market's going to give you, what you believe it's going to give you. You run the numbers and then you pull the trigger and you invest in something. And so if that turns out to be single family, so be it. And if it's a different type of asset class, that's fine too.
You mentioned, once you find a good turnkey provider, and I'm sure that's probably one of the critical things to do to have success doing that. What are some of the things to look out for or to stay away from when trying to find or research a turnkey provider?
finding a turnkey provider is obviously very critical to success because, that's how you're sourcing your deals. The first step is really understanding what it is they do. They're going to go and look for houses that are, have deferred maintenance. They're going to fix them up. And so right there, they're going to do work on this property. You, as a investor, have to have systems in place where you're going to check that work and make sure that it's not shoddy. Right? They're actually putting quality materials in. The work is done properly. And the best way to hedge against that is to hire your own property inspector, right, when you're buying, and really talk to them before they go and look at the house. So you're not going to use an inspector that the turnkey provider provides. You want that to be completely separate, independent. And when you talk to them, you're telling them what it is you're doing, what the business model is for the turnkey provider, the renovations that they're performing, to get this thing ready for rent. And then let your inspector be your eyes on the ground, let them go and look at it. And then as soon as they finish inspecting, you need to talk to them, right? Have a meeting and ask questions about basically all the renovations. Are they cheap? Are the materials new? For example, is the roof new? If not, how much service life does it have left? And you need to do that for all the expensive items, right? It's not just the roof. You have the HVAC, you have the hot water tank, etc. And then there are some other things that you can do. For example, I only buy if it has a brick exterior because it's low maintenance. I do not buy if it has a septic system. That's step one. So that's the maintenance side of it, right? And the renovation side and how you're going to check that. Another area that you got to watch out for is the purchase price. A lot of turnkey providers like to price their property above what it's going to appraise at. So they're going to try to gouge you. So you protect yourself with the purchase and sales agreement. You make sure there's a contingency in there that says if this thing doesn't appraise at the asking price, then you can exercise your contingency and get out of the contract. And then you just have them send you another one. As you do that multiple times, they'll start to be careful and send you stuff that's going to appraise so that you don't have to bring more money for your down payment. And that's critical, right? You don't want to put more money into the property that's going to hurt your return long term. Short term. Long term, it'll end up working out, but you don't want to do that. That's not ideal. And so that's on the purchase side of it. But after you purchase, right, they're going to either send your property to somebody else to manage, or they're going to manage it in-house. I like to see them manage it in-house because now they have a vested interest to perform for you. Their hope is to continue selling you properties, right? So if they're going to manage it in-house, you get to see how their management team is. They have still skin in the game, and again, that I think is important. And then, of course, when I screen them, I have a questionnaire where I ask tons of questions on exactly these type of things. And I'm looking at how their management company performs. They should know the statistics for how they're performing. If they don't, it means they're not monitoring stuff. And if they do that, they're kind of flying blind. So you don't want a company who's flying blind. You really want to see that they have good processes in place and that their management teams are performing well. And I've said this before, but if you have the best property in the best location with really bad property management, you're going to lose money until you fix the management side, right? If that does happen, right, you can get rid of the management company, and then you can go and screen other management companies, find a good management company, and then put your property with there, and then you'll do just fine. But better to take care of that in the beginning. And so those are some of the big risks with turnkey. But if you solve those problems, and I have, and that's really the key, then what you're left with is a investment vehicle that you can scale as many properties as you can afford, and you don't spend much time on it, right? So when you buy a house, it's 15, 16 hours of work stretched over 3 months. When you manage going forward, I only work about 2 hours or less a month. It's actually lower than that. In the book, I put 2 hours, mostly because I wanted people to realize you still have to work on this. You still got to look at your financials and whatnot. But the reality is I can do that very quick, and it's actually lower than what I claim in the book. And so that's really the advantages to this. And of course, the returns have been very good if you do it properly.
How much involved are you getting in terms of like the decisions of what to do, right? So obviously there's the property manager, but what if they come and say, all right, the roof needs to be repaired? How do you make that decision of, yes, let's repair the roof and let's do it like this? Or do you just say, okay, obviously you have to have some sense of trust in the property manager, but at what level do you trust them to do something versus you kind of evaluating a decision?
First off, I don't buy a house unless the roof is either new or 2 years old or less. They send so many properties that you can afford to be very selective on what you purchase. But let's just say, hypothetically, I did have to put a new roof on, or how do I handle some of these maintenance issues that might come across? So to begin with, most property management companies are going to have a threshold of, say, $400 or $500. So any repair that's required below that, they're just going to go ahead and take care of it. Anything above that, they're going to communicate that through you, usually by email. You'll get an email, and they'll have like a portal type system where you can go and get your statements, that sort. But they're going to communicate that to you, and they want you to look at it and then approve the work. And the way it normally goes is they're going to send you pictures of what's wrong so you can see it, for one. And so then you can go and you can assess it yourself. And I know some people are like, well, I don't even know which side of the hammer to hold. So that might be a problem, right? You may need to learn a little bit if you're wanting to look at these images and decide for yourself if it's an issue. Of course, you can always have a friend or somebody who may know something about it and you can show them. But the reality is they're going to send you pictures, you're going to look at it, and then you're going to approve that work or not. Now, if you have a roof that needs replaced and it actually needs replaced, you really need to replace it, right? That's going to quickly turn into a more expensive item down the road, right? The water's leaking through, it's going to destroy plywood underneath and what have you, and then you'll have to change that plywood. So the reality is you have to have some trust in your management companies, but you also have to think about what you're doing and just look at the images that they send you and make sure that it makes sense.
Do you ever visit the properties, either before you buy them or like once a year, or are there some that you've never even actually physically have seen?
I haven't been to any of them. None of them. I'm not better than a property inspector. And when they walk that property, I'm talking to them. Right? They are my boots on the ground. And so I put a lot of effort in really screening a property inspector. And the reality is, if you see a house that's fully renovated and you have the scope of work with the materials that were used, which is what they'll send me, and I know the square footage of the home, and I can go on to Google Maps and I can look at the surrounding area and I can get a really good feel for that neighborhood. And of course, there's some other analysis that I did just to decide I was going to buy in that metro. From there, I've got a pretty good feel for it. So no, I don't visit the houses. I know what they look like. I have not physically been there. I don't know any of my tenants, and I really like that. When I was managing, I learned very quick that I was not a good property manager. I knew exactly how to do it, what to do, and over time I got a lot better, but I'm a bit of a softie, so I prefer not to know. Let the managers who are professionals that do this all the time, let them handle things. They know how to do it. They know the law, so they can actually keep you out of trouble, right? They're going to follow all the housing rules, etc. That's really my approach to it.
All right, Scott, that's all the questions I have for you today. I want to thank you for joining me on today's episode of The Agent of Wealth. You provided a lot of great info on the world of turnkey real estate investing. Where can listeners go to learn more about you and pick up a copy of your book?
Yeah, sure. So you can go to my website, scottastanfield.com. There's a way to get a hold of me there through email. You have questions, ask. The whole reason I'm doing this is to try to help people get started and help people go down the same path. So if you have questions, make sure you email me, ask questions. The website has tools there meant to just help. There's also a blog article or blog series there, information about my book. You can find it, at Amazon. There's also a place to buy it on my site. The book, I put a lot of effort into that. It has all the financial information, how to calculate all the checklists, my actual criteria, how I do everything. It's literally everything I do is in there and more. And that's done on purpose. It's meant to be a roadmap for people.
Great. We'll include those links in the resources section of the show notes. Thanks again, Scott, and thank you to everyone who tuned in today. Don't forget to follow The Agent of Wealth on the platform you listen from and leave us a review of the show. We're currently accepting new clients, and if you'd like to schedule a one-on-one consultation with our advisors, please do so at bautisfinancial.com/call.
Thank you for listening to the Agent of Wealth podcast. Click the subscribe button below to be notified when new episodes become available. The information covered represents the views and opinions of the guests and does not necessarily represent the views or opinions of Bautis Financial. The content has been made available for informational and educational purposes only and is not intended to be a substitute for professional financial planning and investment advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investments and financial planning.